So I use an approach using a model of the market called the wave principle. It's the way that we label and chart the movements in the market. Generally, bull markets occur in 5 steps, an up, down, up sequence, and after that you get a bear market. We've labeled this as completed in January 2000 when the Dow made its high at that time. That was the real value peak for stocks, and therefore we think our model is accurate when it says we are in a bear market period, even though the nominal prices that are a new high. And with that labeling, the next move is to the downside. Now, we all know that the Dow this month, on the 11th of October, made a new all-time high in nominal terms. So did the S&P by a very tiny amount. Even Treasury bills have outperformed the S&P for the last 7 years, but in nominal terms, it did manage to make a slight new high. Those are what get the headlines. That's what you see when you tune into the financial television. But they rarely show you some really crucial indexes out there. This is a short-term picture. On the left of this graph, you'll see the peak of July of this year. So this is a daily picture coming out to the present. The top index is the Dow Transportation Average. If you know anything about Dow theory, you know that there's a problem in the market if one of the two averages between the industrials and the transports is not confirming the trend. Well, the Dow made a new high all by itself. The industrial average, the transports are lagging tremendously. This is a red warning signal from Dow theory that there's something wrong with the uptrend. It could be reversing. Now look at the middle graph. This is the S&P Banks Index. This thing has just plummeted below its August low. And the one below that is the Home Builder Index. It's making new lows every month. Now look at those tiny arrows. I put an arrow there for a reason. You see that big up day that it had in the middle in all 3 of these indexes? That's the day that the Fed lowered its discount rate. And everybody said, oh, this is so bullish for the stock market. The Fed is going to save, the mortgage market and the bank problems and everything else. If that's true, then why are banks making new lows in the stock market? Why are home builders making new lows? The people that were supposed to be helped by this are obviously not being helped. Why is that? I think this next graph is one of the most important ones you'll see at this conference. I can't open a newspaper, I can't turn on a television without hearing someone say, the Fed has announced that it will now be flooding the market with liquidity because it lowered its discount rate by 0.5 point. As this shows, and this goes back to 2000, and we've got it going back much further than that, this is not the way the Fed inflates the money supply. It inflates by buying assets. In terms of the interest rate, it simply follows Treasury bill rates. The thin solid line is the T-bill yield. The dashed line is the federal funds rate of the Federal Reserve System. And look at the time difference between the two. The Treasury bill rate moves first, and then the Fed follows. It follows that rate very faithfully. It's not rocket science what they're doing in terms of changing the interest rate. They're simply following the Treasury bill rate. Now, if you notice in the upper right over there, the Treasury bill had fallen. It had peaked out in September in terms of February in terms of its rate, had fallen more than a full point. So when September rolled around and economists were saying, oh, they're going to lower it about 1/4 point, we were meeting in our offices saying, look, 0.5 point minimum, because they have to catch up to the T-bill rate. They're coming out again on October 31st, having another meeting. I would say the odds of another rate cut are very, very high, because if they're following rates, they're going to have to lower them more. Well, what does it mean? Before we get to that, I want to say if you don't want to believe your eyes on this chart, listen to the chairman. He was on CNBC in September, and he was asked, did you keep interest rates too low for too long in 2002-03? And he immediately interjected and said, the market did. So he's saying the Fed is just following the market. Well, some people don't trust Alan Greenspan, but your hero and mine, Jim Rogers, had the same thing to say last month on Bloomberg television. He said, listen, the people who pay attention to the Fed don't understand the markets. The Fed follows interest rates. The Fed follows the market, not vice versa. So when you hear all these economists telling you that the Fed is lowering rates so it can flood the system with liquidity, that's not how they add liquidity to the system. The market, the the billions and billions of dollars worth of bond traders and bond owners out there are the people who set the Treasury bill rate. Whatever they demand is what the government is going to pay. And right now, for whatever reason, they don't want more than 4%. Now, the other thing we keep hearing, and I think this next chart is another crucial one, is that dropping interest rates is going to be very bullish for everything because it's adding a lot of liquidity to the financial system. If that's true, then how come 3 out of the 4 biggest bear markets in stocks in the last 80 years were accompanied by dramatically falling interest rates? What does it mean when an interest rate falls? Why do prices go down for anything? When demand falls for some particular item, the price goes down. And when demand for credit falls, its price goes down. This top graph is the decline of the early 1930s in the United States. The Dow lost 89% of its value. And interest rates are falling throughout that period from 5% down to 2.5%. The middle graph is the Japanese Nikkei earlier in this decade. Interest rates were 4.5% at the high. They went all the way down to 0 and stayed there for the last year and a half of this bear market, but it didn't stop the bear market. It meant that there was a lower demand for credit. And credit is what is holding all these prices up. Declining interest rates are not bullish. They're a sign that there is a problem in the credit area. The last one on the bottom is much closer to home. This is the drop in the NASDAQ from 2000 to 2002. It dropped, lost 78% of its value. And this is in dollar terms. Forget about real terms, it was even bigger. And as you know, interest rates started at just under 6% here and went all the way down to 1/4%, lowered them quarter after quarter after quarter. The Fed was lowering interest rates, and it didn't stop the NASDAQ from losing 80% of its value. So if you think lower interest rates are going to keep stock prices up, please at least reconsider that idea.